Life insurance is one of the most fascinating financial trends in the world right now because we're seeing a massive shift. While Western countries like the United States, Canada, and much of Europe are experiencing stagnating or declining life insurance ownership southeast, Asian countries are witnessing explosive growth. In today's video, we're going to explore why this is happening, what's driving the shift, and what it reveals about the future of global finance. And trust me, once you see these differences, you'll never look at life insurance the same way again. Let us begin with the simplest question. Why is Southeast Asia buying so much life insurance right now? The reason is a combination of rising incomes, growing financial awareness, and a very real desire for financial protection in regions where social safety nets are still developing. In countries like Vietnam, Indonesia, the Philippines, Malaysia, and Thailand, millions of people are entering the middle class every single year. And when people move from financial insecurity to stability, the very first thing they think about is protection. Life insurance becomes a crucial foundation. It's not considered optional, it's seen as a responsibility. But what's interesting is that this growth isn't only due to economics. There's also a strong cultural factor. In Southeast Asia, people overwhelmingly live in multi-generational households, and family obligations run deep. Parents feel responsible not just for their children, but often for aging parents, siblings, nieces, nephews, and extended relatives. One sudden financial emergency can pull an entire family backward. Life insurance becomes a shield that protects the whole family system. In contrast, many Western countries, especially the US and Europe, operate with a much more individualistic financial culture. Children move out earlier, extended families rarely share financial obligations, and people rely more heavily on government support like pensions, unemployment benefits, and public health care. Because of this, life insurance in the West often feels like a nice-to-have, rather than a cultural necessity. Another major reason Southeast Asia is booming is the rise of digital insurance. Traditional insurance was slow, complicated, and paperwork-heavy. But Southeast Asia skipped an entire generation of legacy systems and jumped straight into mobile-first app-based insurance. Today, companies like Prudential, Aya, Manulife, and regional startups make it incredibly easy to buy microinsurance, term plans, health riders, and savings-based policies with just a smartphone. You can buy coverage in under 5 minutes. It's priced for developing markets. This creates a massive consumer base of young adults, people in their 20s and 30s, who are now buying insurance earlier than ever before. Meanwhile, Western consumers often see insurance companies as outdated, slow, and overly complicated, which contributes to declining interest. Let's talk about trust, because it plays a huge role. In Southeast Asia, trust in insurance companies is rising, largely because these companies are seen as tools for financial empowerment. Younger generations view insurance not only as protection, but as a wealth-building strategy, especially because traditional savings accounts offer low returns. Insurance-linked savings plans and investment-linked policies feel safer and more structured. Western countries, on the other hand, have a declining trust issue. Many Americans believe insurance companies are too expensive, too confusing, or only benefit the company, not the customer. Young Europeans often believe the government will provide enough safety through public systems. They don't feel the same urgency to buy coverage. Aging populations also play a surprisingly important role. The West is aging rapidly, with fewer young people supporting larger elderly populations. This has put enormous pressure on public welfare systems. Ironically, this makes life insurance more necessary than ever, but younger people feel financially stretched and are delaying or avoiding it. Southeast Asia, while also aging, still has a much younger population overall, which means more people are buying life insurance at earlier stages of life, creating long-term growth momentum. These countries are also witnessing a rise in lifestyle-related illnesses like diabetes and heart disease. This surge in health concerns has made people more proactive about protection planning. Another key difference is affordability. Life insurance in Southeast Asia is marketed with small premiums, flexible payments, and customizable options. People can start with very low monthly costs and scale up over time. In the West, premiums are often higher, regulations are stricter, and customer expectations are different. Many households already feel financially burdened by mortgages, credit card debt, student loans, and rising cost of living. Life insurance becomes just another bill, so people cut it out. There's also a psychological factor. Southeast Asian societies have a heightened sense of financial risk, especially because many people grew up watching their parents or grandparents struggle through economic crises. The idea of financial loss feels more real and more immediate. Insurance is treated like a tool of survival, not luxury planning. In the West, the feeling is almost the opposite. Decades of financial stability made many consumers believe everything will be okay. Savings accounts, government programs, and pensions created a sense of security. But as economies change and governments face more financial pressure, Western consumers might eventually return to life insurance out of necessity. Finally, we need to talk about education. Southeast Asia is becoming one of the most financially educated regions in the world, especially for young adults. Schools and governments are promoting financial literacy. Influencers and online educators are teaching millions about savings, investments, and protection planning. Insurance companies are creating simple content that explains policies in fun and easy ways. This new generation sees life insurance as smart planning, not complicated paperwork. In the West, financial literacy hasn't kept pace. Many young people are unsure how life insurance works, what policies mean, or why they matter. And when people don't understand something, they tend to avoid it. So when you put all these factors together, rising income, cultural responsibility, digital innovation, trust, affordability, health awareness, improving financial education, you get a region where life insurance is booming faster than almost anywhere else in the world. Meanwhile, the West is experiencing stagnation, distrust, and shifting priorities. But here's the big question. What does this mean for the future? The truth is, Southeast Asia might become the global model for how modern insurance markets grow. Western countries may need to learn from Asia's digital-first approach, simplified products, and educational content to rebuild trust with younger generations. And as more Southeast Asians grow wealthier, the region could eventually become one of the most important insurance markets in the world. In the end, the story is simple. Southeast Asia sees life insurance as empowerment, while the West increasingly sees it as an obligation. One mindset leads to growth, the other leads to decline. And as global wealth shifts, we'll continue to see these two regions moving in completely different directions. Thanks for watching, and stay tuned for more global financial insights on Global Wealth Lens.